guys, welcome back to the Capital Mindset Show. This is actually the second time I'm filming this video because I think the first time I was a little bit too harsh. So I'm going to be a little bit less harsh in this video. But the premise of this video is to talk or re-speak about a company that we've covered in the past, kind of review what happened. In hindsight, it was correct. So, looking back at what we said about this particular stock, which is PayPal, we were correct in our analysis. And now we're going to reevaluate it, but also it's going to be talking a little bit about, and hopefully in this iteration, a little bit less harsh, because I don't like to be too harsh, on another creator who is significantly larger and who spoke about this stock. But the reason why I'm speaking about them in particular is that their video was sent to me. And then I was also asked by an individual what I think about this video, what I think about their analysis of what they did. And then talk about it. And also to mention that they do have a course that they sell for about $300 US, and that teaches other people how to do analysis as they do. And I almost feel like I should just make a course myself and just put it on YouTube and then just have it for free, because that's the level of value I think that probably provides, because we'll get into it. We'll get into the analysis in that part, but I want to be a little bit less harsh in this iteration. Okay, so before we begin, let's actually talk about PayPal, and we're not going to dive super deep into what the business does. I think in the original video, and I'll showcase that video here, we went into a decent dive as far as the main part of the business. And I think for the most part, everyone can grasp what PayPal does. They do payments between each other, or between people, between businesses. They're like a commerce play. They make money off the top, so they skim a little bit off the top, and then that's a very profitable business. But I'll actually discuss some things that I'm concerned about with PayPal, but we'll get to that actually. All right, so looking at the 1 year, this stock has severely underperformed the overall market. It is down 56.87%. If you had been invested in this, I feel very sorry for you. And then I will discuss where our analysis came in and then what kind of happened. So our analysis was in early December, and it was about $180 something. And I think I have it right here, right? So this is the video where we first spoke about it, December 6th. We are still a small channel. We only got 250 views, and that's completely fine. And then we had the price of 183.93 at the time. And then we saw the summation of this analysis. You guys can go watch it for yourself, because we compare PayPal and Fiserv. But the summation is that PayPal, based on our assumptions here, was significantly overvalued. And you can see what the fair value estimates were at the time was closer to $100, $118, right, for the 22% growth rate going forward. And if we go back, right, at what the price is right now, it's about $122. Okay, so to reiterate, $118 was our high-end fair value estimate, versus what it is right now, $122. Okay, so we're actually approaching the high-end fair value estimate. We're going to go back into the model, and then we're going to see if we can make any different assumptions, and we're going to go over like what the business as reported, etc. Okay, and then the video in particular that I will be discussing, this is the one I watched and was sent to me, and it's this one right here. So this individual who is, well, you can read his name, and then PayPal stock, blah, blah, blah. The point is, on the time, it was December 22nd, 2021. So it was actually a little bit after we made our video. And the assumptions made in this video are extraordinarily interesting. I see, I don't want to be harsh. It's extraordinarily interesting. Maybe some people might think I should be harsh, because technically he is a person with an accreditation. And so with that comes a lot of responsibility, especially when passing out information. This individual supposedly is a CFO. So that also comes with a lot of responsibility, a lot of expectations on knowledge. But I personally am not the one who wants to be harsh. Okay, so basically from their analysis, we can see that it was December 22nd. Or was it December 22nd? I want to be perfectly accurate, December 22nd. So let's look at the ending price on December 22nd when the video was released. And let me go there. Okay, and 36%. Okay, so, and the problem is, if he had been cautious on it, it would have made more sense. But the thing is, his analysis was so bullish, right, about PayPal and so many positive things to say about PayPal, we have to be careful on YouTube not to create echo chambers, not because I, for example, want to be a channel where you can rely on me to be someone who can give an honest opinion that you may or may not agree, right? But you'll hear my honest opinion, all right? And I'm not going to be a hype beast per se. I'm not going, and this person's not a hype beast. I want to be very clear. This person's not a hype beast. They're not nearly, when I watch the video, they're not nearly as egregious as others, but their level of analysis was not up to what I think is the standards that people should set as far as levels of analysis. And in fact, I do not personally, in my opinion, believe that that level of analysis has a price tag of about $300 for people to learn. Okay, I actually think that level of analysis is very rudimentary. It's the basics, and it actually should be free. And I'm highly debating whether or not I should just like make a video on here, and that will be my quote unquote course for everyone to use, because that, you know, okay. I'm trying not to be too harsh there. All right. Anyway, but the point is, we're going to get into the specific points made by that individual. Okay. All right. So let's actually get into the business, right? What happened? Okay. Because it is down. So something happened that kind of rattled the market. The market was like, ooh, that's disgusting. Okay. So let's take a look at their reporting metrics right here. It looks great. So net revenues are up on the quarter, 13%. Net new active users, that looks like a bad number. It's down 39%, but that's net new. So it's all the new people coming in. Operating cash flows are up 31 and 38%. That's good when the revenues are smaller than the cash flows going up, because that shows like efficiency improvements. So that's great to see. Obviously, we want to make sure that revenue is growing, and they're just not, trying to become more efficient only. We want to see growth in all aspects. Total payment volumes are up 23%. And this is what we were discussing in the last video, and by the way, that also individual also, I want to give them credit where credit is due. They did say this as well, that PayPal is a company that, skims off the top of each transaction. So then as, prices rise, so if you're in an inflationary environment, that actually won't matter for a business like this. I would say that, for example, Visa and MasterCard are higher quality businesses than PayPal. And I'll kind of get into that. There are no videos on this channel about those, because usually I don't think that there's a really good opportunities to get into those stocks. They're so good. They're such good companies that they're always trading expensive. But PayPal is similar in that aspect, where they take a percentage of the transaction. So companies like that do not really care about inflation per se. They care about inflation as regards to how much it affects the transaction volume. So if prices rise too much for that population, maybe in aggregate, the actual volume doesn't really grow, right? So maybe people don't buy as much, right? That can happen as well. Okay. So what they are going to be sensitive to is recessions. Okay. So you got to think about it like that. And then, are we getting into a recession at any point in the future? That's something as an investor you have to consider. Okay. That's the nuance. Okay. Because that can severely affect their expectations, because their expectations are based off of past performance. And this is number one mistake that this individual made. The expectations they laid forth going forward into the future was based simply on past performance. And then they said, and I quote, they 5x'd in the past. I think they can do something like that going forward into the future. And this was referring to a 10x, so a 5x over 10 years. So the belief is they can 5x again over the next 10 years. Wrong, bad assumption. You don't want to extrapolate from the past. You want to actually look at the business, look at the laywork of what's going on in the world today. And then from there, draw your assumptions. And then set a plethora of assumptions. And you want to be as conservative as possible, assuming that they're going to 5x in 10 years based off of their size currently, and not considering, which I will get into, because this is where nuance is so important for each investor, each investment as well. You have to consider the overall landscape of that industry, which is competition. So I'll get into that in a sec. Let's finish this. All right, guys. So they had a strong quarter, strong year. Then they said full year revenue increased 18%. That sounds great, with eBay growth of 29%. So still a good reliance on eBay, but that's good. Money is money. Bring that money in, please. Ongoing customer engagement growth, great. All this sounds amazing. Remember, this is the sales pitch, right? I always say this when we look at these things. This is the sales pitch. If I don't see something good in these things, there's nothing good anywhere else. This is where the management's going, hey, look at us. We're amazing. Okay. All right, so let's look at that. DoorDash. Okay, so DoorDash added PayPal as a checkout option. So why do people choose PayPal, right? Because for those of you who may not have familiarity, they'd be like, oh, well, why do we choose it? Well, PayPal as the customer, it gives a proposition of safety. So then if I want to be safe on the internet, that was the original intention of PayPal. I want to be safe on the internet, make safe transactions. I'll utilize PayPal to protect me. Okay. And then a lot of people will only pay through something like a PayPal. Now there's a lot of options, and that's what I'm going to get into. But yeah, we'll get there. All right. So delivered strong while returning 3.5 billion to stockholders. That's probably the buybacks, and then cash equivalents, blah, blah, blah. Debt approximately 9 billion. Okay. So their debt levels are pretty great. Cash and cash equivalents of 16 billion. So yeah, they're really good balance sheet. Really great balance sheet. Proposition to customers and merchants globally. Okay. This is actually where I'm going to get into it. All right. So I do business internationally. And when it came push to shove, I had several options, right? PayPal was one of them, right? What I saw is that PayPal as a option within the market was frankly not that good. Okay. So I chose to use a Stripe and Wise. Those are the two services that I utilize for receiving payments and sending money out into the world. Okay. And also the business that I work for, they do the same. Okay. They don't use PayPal. So PayPal is one that I think you could think of it like it has these customers, but these customers are fickle. Like if another guy comes in and offers me like the same level of security and everything like that, but then takes off a little bit off the top, businesses, for example, are going to be much more keen on using that service than PayPal, simply because if you think about it as a percentage term, it's going to be a big expense, right? Because if I take 5% of your revenues versus if I take $5 a month, right? And these are fake numbers, by the way. The 5%, if it's off of a small base, is nothing, right? If it's off of $100, they're the same, right? Now, if it's off of millions of dollars, now I'm paying the 5% a lot more, all right? So I'm going to take the one that has the same service, right? And then that's the assumption, the same service, but the lower cost basis. And then over time, those savings are going to be very attractive to me. So PayPal has to make the value proposition very strong. Okay. So again, their value proposition typically more or less lies in that if you utilize our service, there's a lot of other customers that wouldn't have otherwise used your service that will now use your service. Amex uses the exact same logic, right? But Amex, the thing with Amex is American Express customers, right, are high spenders because they typically are higher net worth. Okay. And then so that's what Amex advertises, like, why should you accept Amex credit cards in your or technically they're charge cards for a lot of them, but you know what I mean, the card, right? Why would you accept the Amex cards? They usually have the highest fees. Well, because they are statistically, they're the highest spenders. Okay. Well, PayPal makes a similar value proposition to merchants. Like, oh, if you accept PayPal, you will have more customers, right, coming. And then so you'll make up for it in the new volumes coming in. All right. So yeah, that's basically what they're basically discussing there. All right. So financial guidance. So this is where I think, not where I think, where I know things went south. Okay. Expected guidance plummeted. Okay. So remember, we had huge growth in the past year. Remember that the future is what matters for stock, not its past. Okay. So now we see revenue growth of 6%. And I love how they throw in the eBay growth down there. They're just like, of that 14% is eBay, like 14% matters because we care about the total. We don't care about eBay, but okay. GAAP earnings. Okay. So yeah, all that. I don't care about that. All right. So revenue and earnings guided. So basically if you see, this is my opinion of what I think someone should look for, by the way. If you think I'm glossing over some things, that's completely fair. And I could be completely wrong on that. All right. But I'm glossing over and trying to see what's important. And this is the first time I've read this document, by the way. So TPV expected to grow at 19%, 22% at current rate. Okay, cool. Then that's, by the way, TPV, total payment volume. That's what that means. So I hope, and then FXN is foreign exchange. Like that's basically currencies. All right. So because this is a global company, they have to mention that. Revenue is expected to grow. Okay, so that's fine. So that's forward year 2022. This is the full year. So the full year is actually expected to grow, decently, moderately, but we'll actually get to this in our expectations, which is again why that individual, I do not know why some of their expectations were what they were. The business itself isn't even telling us that that was happening. So I don't know where they really came from. All right. And then there's another gripe I have that I don't know if I should really get into that gripe, because I feel like I'm being already a little bit too harsher than I really wanted to. All right. So all this, the model will pick up for us. We don't need to care about any of this. All right. So I think it's fair enough that we go here to the model. Okay, so I already plugged it in actually. So PYPL, we have a price target from analysts, right? These are the CFAs, analysts, 199.23, 62.5% upside implied. So if you think that I'm completely wrong and that the analysts are correct, then that is what they believe. Okay, and I always like to show them and then kind of compare what it is that we are seeing on this channel. Okay, remember my previous conclusion on PayPal was it was overvalued, and that was at $180, right? It was not a good value proposition. The assumption that I would have to make were very big, and I wasn't getting good risk reward. Today, hindsight showed us that that was correct. The price has come down. Now today, is it at a good value? Because now it could be, right? Because if the assumptions have changed. So we are going to discount it at our 12%. So 2% above the quote unquote market average, which I do have a problem with that statement. I always mention that I have that problem with that statement because, you know, that assumption is interesting. All right. Anyway, so we're going to include these buybacks to be completely fair to PayPal because they are doing buybacks. Okay. We want to count that the share reduction is occurring. And then over time, we are going to own more and more of the business. Okay. Okay. So this is a debt heavy business, right? They're using more debt than equity. That's being told to me by the model right here. And we don't care about dilution accretion. That is only a number that we care about if they are diluting us on a net basis. They are not. Okay, looking down here that the PE is 34.86, but the cash flows are actually worse. They're at 58.69. Okay, so the net income on a GAAP basis is better than the cash flows. Okay. So we'll actually take a little bit look at the ratios and kind of explore some of this. And then we're going to come up with our growth estimates. Okay. So looking down here, this company is definitely not at risk of bankruptcy according to the model on two metrics. So on the model's own metric, it's telling me no. And on the Altman Z-score, it's also saying no. So, you know, that's kind of indicative of a very healthy balance sheet. And I apologize, everyone, because I completely forgot to change the size of the screen, because I know that the difference in resolutions when I film and the publication on YouTube, it does affect that. So hopefully now it looks better. Okay, now we're going to go to the key ratios and we're going to talk about these. So the current ratio and cash ratio looking pretty good. Cash ratio, I'm not too concerned about that. The current ratio I would like to see in a business like this, especially, I need to see that the current ratio is above 1. There are very few businesses, again, nuance matters, where the current ratio being below 1, I wouldn't really mind too much, but those are very few and far between. So looking at the solvency ratios, things are okay, good. The total debt ratio implies all liabilities, by the way. So it's not just debt, like debt that you owe money to. It implies all different kinds of liabilities. The long-term debt ratio, that is taking into account just the long-term debt. So like I owe $10,000, I need to pay back $10,000, like a debt, like bonds and stuff. All right, so that's, you know, steadily rising, but, you know, maintaining itself a little bit. The gross profit margins are fairly stable, I'd say, growing, but barely growing. I'd say that's more stable than anything. Operating margins, they are rising. Sorry, no, they're declining. Yeah, they're declining there. 2017, my eyes went to 2018 first. No, from 2017, they're actually declining. But, you know, maybe 2017 was most likely like some sort of anomaly year. And then I'd say the average or the mean is where it is now. Net profit margins. So this one has been kind of fluctuating. Okay. And then ROE looks good. ROA, that one is interesting because I don't know what they're valuing as assets, but I paid attention more to ROE for a business like this. Again, nuance. So depending on the business. So that was the DuPont analysis. Earnings quality, the model is actually grading this very well. So that's good. So across the board, every single year was a good score. And then the book value per share, don't really care about that for something like this. And I don't really care about the activity ratios too much. So from here, let's actually get to the assumed growth rates. So now this is where things get interesting. So over the past couple of years, This individual was, again, utilizing past 10 years of data to then extrapolate from that what it will do into the future. Right. This is folly, because statistically we want to see what's approaching to today. And even then, I don't like to use this average growth over the past years. And this takes into account a closer time frame of about 5 years, right? Because then that shows us closer to what it's happening today. As we get closer to today, what's the trend line doing? Okay. And then we can kind of see here, because it's mapped out here, the trend line. So the trend line is, if we revert, we're actually breaking trend. Okay, this is not good. So when this is the trend line, and you want to see the company following the trend line. So now that we're below trend line, we might come back up around here, right? But here's the thing: we were above trend line here, and then this could be a result of this massive change, right? So we could be coming down because we jumped way above trend line. Okay, cash flows, they are lumpy, but they follow the trend line. Okay, this is the trend line. So that's something to think about. They might actually recover the growth, but their growth is going to be slowing down. But even then, when we account for these 5 years, the growth rate has been only about 14.4%. And then from there, remember, the revenues, without revenues, we don't derive any cash flows. So from there, we can derive cash flows. And then sometimes I believe that is warranted, depending on the different specific parts of the business, that we may actually include a higher growth rate in cash flows over the sales, over the revenues, right? Because it just depends on what the business is doing, where they are in their stage of growth. There's a lot of different factors. Okay. So I think, for example, this business, we could say that they could grow feasibly at an average of, I'd say 13%. Okay. 13% in cash flows is where I can safely say they'd probably achieve that. Okay. Where I'd say is the high end is definitely in the 20s. So 22 or 20%. All right. So 20% growth in cash flows. That's where I think that's like the higher echelon of what they can achieve. Remember that, can they achieve that with all this competition? I, for one, don't use PayPal. I don't use PayPal even as a consumer. I think when I had my tutoring business back in the university days to pay for university, I did accept payments through some PayPal services. I was basically open to any payment service: Cash App, PayPal, well, not PayPal per se, but Venmo's owned by PayPal. So that was, my experience with it, and it was fine, but I never kept the money in their service. I would just take the money out, take it to my bank, and then, do whatever I want with it. I would never leave it in Venmo. I would never really pay anyone through Venmo. I'd Zelle people, because I'd be like, why am I going to pay Venmo any money? I'll just Zelle you. So anyway, regardless, there's so much competition in this space. PayPal is not the actual moat. They don't really have the moat that people really think they do. The ones who do have the moat are the ones who's the rails of the system. And the rails is actually used by the industry, right? That's actually the term. So the rails are Visa, MasterCard, American Express, Discovery. These are the different networks that actually have underpinnings within the financial system globally. Okay. So the two that have the biggest moat is Visa, MasterCard, and the one who has probably the largest moat of them all is American Express, because they control the rails themselves, and they have the branding of the card, the front facing of the card, because technically Visa and MasterCard, they are not the brand of the card. So, you get your credit card through JP Morgan Chase, and then that's the bank. And then you have the network, which is Visa. So they're the bank / issuer. Visa is the network. And so American Express controls the whole thing. I'm not saying American Express is a good company to buy right now. Not saying that at all. Just describing the differences of what you have to think about. Something like PayPal has a lot of competition. I can name a lot. And then I express concern that something like WeChat actually in China and WhatsApp everywhere else in the world. Okay. That is heavily concerning to me, because I see those businesses encroaching on this. All right. This is not a walled garden. This is not that much of a walled garden as we think. Okay. And that was, again, a big concern of mine. All right. We see, again, I point to WeChat in China and WhatsApp globally. They are encroaching on this service, and it's fairly easy to use. All right. So 20%, am I stretching? Perhaps I am. Okay. But I'm going to assume it. And then on the low end, I think that they could grow probably because the pie is expanding so rapidly, digital payments are expanding so rapidly, everyone can kind of benefit. It's just they may lose their ability to grow as fast. So I think they still can grow at like around 10%. Okay. So from here, now we can fill in our assumptions and just put 11, or let's be a little more generous and upgrade it to that. And then we'll do probably 16%. Okay, so 16% is the, remember the reason why it's different from the video right here, where you see that, take a look at the discount rate of 15%. I'm barely implying a discount rate above that, and that would imply a 210% upside. This is technically market beating returns based on market averages. I do think, for example, the United States, depending on what your index is, the United States will underperform compared to what it's done in the past. And I'm saying compared to what it's done in the past. Keywords of what I'm saying, don't take that out of context. So I don't think it will do as great. All right. So 12% is actually a decent return over the next 10 years, probably. So, you know, anyways, the model right now is not liking this. It's not liking this based on the risk and the assumptions. And it's actually recommending I do not actually add this to the portfolio with a recommended weighting of negative 2.16. But let's say I do believe, for example, that this is the most probable. And I'll switch these. I'll say this is 30%. And you see right here, by the way, when I have it incorrect, it will always correct me. The model will tell me, hey, you're wrong. Hey, stupid. So we have to lower this by 15%. All right, so I want to switch these up and then say that that's probable, and then we want to use the assumed. Okay, so even with the more probable scenarios being 4 and 5, the model's still not liking the prospects of this, right? Even though in scenario 5, it's a buy right now, based on the assumptions, based on the risk, based on the risk profile of the debt, which is not really too much of a factor, or it shouldn't be too much of a factor. Even with these buybacks, etc., the model is telling me no, it's not really interested at these current prices. Now, if the prices were to fall, if it goes sub 100, the model will probably, this would escalate, and then it would probably tell me, you know, you could probably get, you know, 2%, 5% of the portfolio in there. And I don't take this, you know, like law. I don't follow this, you know, blindly. I use it as like a poll to kind of say, okay, what does the model tell me? And then I make my own assumptions after that, or my own judgments after that. All right. So I think maybe I make my point rather clear. If I plug in 15%, it's still not a buy. I think I even assumed greater growth rates in the past, but now I'm bringing them down because new information has come out that they are experiencing a little bit of a slowdown. It may be harder for them to grow into the future. And I'm adding that extra nuance that all this competition is coming in. But let's see what we would have to imply, because I want to show everyone that who's curious. So if we are at a 22% growth rate, we're right there. So that's what you would have, that's what would occur. And then you would be fine. You get that 15% required rate of return. And that would be about 304% over the next 10 years. All right. That would be the quote unquote fair value currently. And we're right there, basically. We're at fair value. If you wanted a greater margin of safety and you wanted, you know, higher expectations of growth, let's see what we'd have to imply. And I think we'd have to get way above what they've done in the past. So let's actually see 30. Yeah, 30 definitely. So 30% right there. That's what we'd have to assume in order to achieve that 20%. And I would definitely not be comfortable with making that assumption. I think on this note, actually, I'll get into one last point, which I'll stress in other videos because I do stress it a lot. The topic of EBITDA, enterprise value to EBITDA. Oh my gosh. Okay, so one thing that's little known, when I was in university, there was a professor I had, and we got along really well. Unfortunately, he passed, and right before he passed, we were actually in the middle of doing a study, right, that was going to be published, but unfortunately, he did pass, and I still learned a lot of valuable lessons from that study that me and him it started, but we didn't finish. We ended up not finishing. But the point is, enterprise value to EBITDA in the past has been one of the worst metrics to actually value a company by. The worst, absolute worst. The reason why is enterprise value to EBITDA is not good for evaluating stock purchases. It is not good. Please stop using it. Stop listening to people, or you can keep listening to them, but take this information and then understand what they're saying and take it with a grain of salt, but understand this, okay? Very important information in my personal opinion. Enterprise value to EBITDA was designed in the 1980s as a metric to evaluate whole acquisitions of companies. Now ask yourself, if you're looking at PayPal, are you going to buy all of PayPal? No. Are you doing this as a play that it's going to be an acquisition target? That could be a reason why, right? Because you would use enterprise value to EBITDA because you're thinking from the perspective of an acquirer and you want to buy at an attractive acquirer multiple, which is enterprise value to EBITDA. And you're hoping that the company that buys it, let's say Google buys PayPal, you want to see, okay, I'm getting at this enterprise value EBITDA. Google will probably pay this level of enterprise value EBITDA, and then that's why. So enterprise value EBITDA was designed for acquiring entire companies. Okay, I actually do utilize it when I'm analyzing private businesses. Enterprise value EBITDA, right? I will use it, right? But not when I'm trying to buy a stock. It does not make sense because you are not acquiring the entire business. You're acquiring a piece of the business. Okay. Okay. And then there's the other gripes with EBITDA. All right. EBITDA is a nice little proxy cash flow metric. Do not equate it to the actual cash flows. Why? Taxes are a real expense. Interest expense is a real expense. That is cash leaving the business. Let me repeat. That is cash leaving the business. If I, for example, making $100 and taxes are $50 for whatever reason, and then interest expense is $50 again, I have $0 in cash. Okay. What can I give to my owners? Nothing. Okay. Then if I look at it from the EBITDA, I'm like, oh, I have $100. I'm making $100. You see how silly it is? So the point of EBITDA, again, is to acquire entire businesses, because in theory, you will eliminate the debt. You will pay off all the debt or assume the debt, and you're going to add that operational aspect of the business to your business, right? Because you're acquiring the entire business. So then it makes sense to use EBITDA. Okay, that's when it makes sense. Not when you're doing that. And also think of it also like this. Why would I exclude taxes in acquiring an entire business? Well, because I pay taxes, right? When I acquire that business will add to above line item of my taxes. So therefore, I'm going to use EBITDA. Now you can, I hope I was clear. So now, please, if I'm not clear, ask down below, and because I want to make sure I'm giving the information as digestible as possible. But that is what EBITDA was designed for. Do not use EBITDA for individual stocks when you're buying stocks, pieces of companies. Do not do it. Do not do it. That'd be so silly if I went up to a company and I was like a private company, and we're sitting at the negotiating table, and we're only going to buy 20% of the business. If I'm going to buy 20% of the business and I'm going, okay, what's your EBITDA numbers? That guy's going to laugh his head off, because he's going to that's a really bad starting point, because, for example, I am not, the tax of the business is the taxes of that entity. It's not mine, right? I actually am affected. I get what's after the taxes. I get what's after the interest, right? We are separate entities. When we become one entity, you can make that argument. Okay. All right. That's pretty much my rant on EBITDA, or using EBITDA multiples for evaluations and stuff like that. It's dumb. It's dumb. I'm sorry. Again, I hope it wasn't too harsh. This is the second version of this video where I'm less harsh, or I think I'm definitely less harsh in this video. And I would say, last commentary, do not go out and pay $300 for a course, especially. Yeah, just don't pay $300 for a course. You know what you should do with that $300? Take that $300 and invest it. All right, just keep your money, please. Keep your money. There's other ways to truly provide value, and tools and stuff like that. That is not a good way to use your money. Okay. All right. On that note, guys, I hope you guys have a great one. I'll see you guys on the next video. If you guys like content like this, go ahead and leave a like down below. If you want me to review other kinds of stocks, go ahead and comment that down below. Again, changes are coming into how I accept stocks. Again, remember the rules: no micro caps, please, unless there's a valuable lesson that I can, grab from that and show everyone in the audience. Because again, the goal of this channel is to build others. We want to basically provide as much valuable information as possible. So don't exclude a microcap just because microcap. Really ask yourself, is there a valuable lesson to be had from this microcap? Then I'll talk about it. There is a microcap that is actually going to be discussed in a very poor light soon. It is a great case study of, I have to be careful how I say it, but a great case study of fishiness. That's how I'll put it. And then Yeah, so just those, and also no biotechs pre-approval of, drugs or therapies or stuff like that, because some of them are not microcaps. I have to be specific on that. And on that note, guys, I'll see you guys in the next one. Have a great one. Bye.